And another reason why it's so important that you're so smart with your money until you find that product market fit. Don't get excited about being a founder and try to get a nice office or try to get like the stuff that doesn't matter. Don't do any of it. Raising money is not a badge of honor. If you start giving away your company, right? That's not a badge of honor. Why would you give away ownership so you can have a nice office? Like the dumbest thing ever in my mind to do, right? So last as long as you can so that you can find that market.
Hi everyone, welcome to Fearless Founders. Ike and I have a great show on today, and he is such a kind man and so experienced. He's so unique, so uniquely positioned. Dave, we're so glad to have you here. And Dave Chidester has a background that is very unique in that he has not only grown multiple tech companies, but he's had the role of being the chief financial officer, the finance guru, the adult supervisor, he may say later on as we go through. And it's such a unique perspective because then you all get to see how the behaviors, the worries, the fears, the concerns, the journey, how the CFO particularly has a unique insight into helping the success of a business. Dave started out with Price Waterhouse, but he's really grown the business over at Overstock from when it was tiny, 2 million or so, up to 400 plus million, maybe 900 million. I may have got that fact wrong. Then after that went public and everything else, he joined another company that was small, Mediconnect Global, and helped that business grow to its exit. So a unique multi-startup, and now he's into investing and everything else, but he still has a steady hand and a love of the first-time entrepreneur, as Ike and I do. Ike, tell him, you know how important a CFO is in the role of growing, or at least a partner, a steady hand. What do you say, Ike?
The entrepreneur job is hard, and it is invaluable to have somebody to lean on, and your family can't be that. Your investors certainly cannot be that. Right? And there's a reason everybody says it's lonely at the top. So you have to find somebody that you can partner with. And I think Dave, you're one of those people. So welcome to the conversation.
Thank you. Thanks for having me today, guys.
And superb, Dave. You were just talking about that whole story of what you've learned now, just being alongside these first-time founders. Just do it again. Tell the audience. That was a beautiful summary.
Yeah, I just think it's I'm not like an entrepreneur. I'm not an idea guy, but I was fortunate very early in my career. Uh, I was at Price Waterhouse. I knew very quickly that wasn't what I wanted to do for a living, but I was getting great experience. I was meeting lots of great people. The nice thing about those public accounting is it gives you some time to figure out what industry do I like? Where do I want to go to take that next job? And I was so lucky that the job right out of there was a startup. And it wasn't my intention, but I was newly married. My wife had a great job. She's like, do it. Go to a startup. This is awesome. So I jumped in, and I was so fortunate that I got into an industry that was um, just naturally growing. Just being in the industry, you knew it was going to grow. We literally were the third pure play retailer, online retailer that existed. There was Amazon, there was eBay, and then it was deals.com became Overstock. And so, we just had, imagine a company, the first year I was there, we did $2 million in revenue. 6 years later, we were at $1 billion in gross revenue. So, and I went from being the controller for 4 years, took it public, and then became the CFO a year later. So just who gets those kind of opportunities? It was just so fortunate. So I was able to see a company go from crazy growth almost to maturity within a 10-year period. So, just I learned very through that experience how fun it was, the building of a company. So much fun, but so stressful, so many ups and downs, so many moments you think, oh my gosh, this is over. Or like, oh, this is going to be $1 trillion company. I mean, you go through all the emotions, right? And and all the dysfunction that's going on, and so having gone through that experience and coming out in the end with a successful exit, a successful public company, I just realized that's what I'm going to be doing. And I'm always going to want to be involved in building companies. And I really saw how the CFO becomes the right hand man to the CEO. You really are the person there. And again, I learned it's not about saying no. You don't want to be a say no person, or people just the founder will stop listening to you. I was always a growth mindset. Anything we can possibly do to grow this. You have to have someone who's a voice of reason to say, okay, we do have these constraints. This is our runway. We have this much cash. We can only do so many things, right? Which thing are we going to focus on with the resources that we have? What are the things that we need to do that'll make it most likely that we can raise the next round of funding? Just all these things to not get in the way of growth, not get in the way of the dream, but to just make sure that we did it in a way that was, we would be able to last, we would be able to sustain, right? And so that just having that role is so valuable for the CEO, to just have someone they can rely on. That's not just a yes man. That's not just going to let them do whatever they want. Sometimes they're annoyed at us because we do put some kind of guardrails sometimes, but it really did. There was kind of the yin and the yang, and investors like knowing, hey, this guy's a dreamer, but I like that I know this other guy's in the room. This other guy's there alongside to just make sure things don't go crazy, right? So I think that's just such an invaluable role to have. And I do think founders sometimes make the mistake of waiting too long to bring finance help into their, because again, at first it's all about revenue, it's all about growth, but sooner or later you're going to have to raise capital. Sooner or later you're going to have to do some things where sooner or later you got to understand your costs, you got to understand your margins, you got to understand all these things. Sooner the better to bring in someone to help with that. And you don't even need, what I'm doing now is, as a fractional CFO, don't need a full-time CFO, but somebody who can come in a little earlier, even just part-time, and give you some of that direction. And that's what I love doing, what I'm doing now, because I get involved without taking a lot of money out of the business. Sometimes I'll just do it for equity, for some advisor shares, because I know how valuable cash is in those early stages. So
such a good talk. Hey, any tech company clearly worth its salt is going to have their technical partner, if not the founder himself or herself. They're definitely going to need help with sales. And he said, so it's better to get them in, get it to have a finance mature person to help, even if it's fractional.
that's
I mean,
right.
it all depends on the trajectory and the velocity of the business.
Sure.
Is it so? People listening in are going to say, "Oh, okay, I'm hearing what a CFO can do to help me, but when? Is there a dollar number? Is there a number of employees? What's a good guidance, Dave, to
Well,
give to people listening?"
first I would say is, bootstrap your company as long as you can. I'm not advocating like bring in a CFO and go raise a bunch of money. I don't think that's what you should do. I think there's no perfect rule for when, but I think it is, if you're getting to the point where you're worried about cash burn and like how much runway you have, and you need someone to really help you understand, what are my expenses, what is going into this, where is my money going, and how do I extend my runway. So on the one hand, can I never raise money? Do I need some help to make sure I can get there? Or if I know that I am going to have to raise money, getting a good, strong financial model, projections, understanding of my costs and margins, being able to talk to all my metrics, all my key metrics, right, that they're going to ask about. Um, Making sure I have all that dialed and understood. Again, the CEO, it's nice when they don't have to come up with all that, but they can then they can learn it, they can understand it through a really good financial model. Um, so anytime you really need to understand, and again, you can have somebody come in once it's all set up. It's 2 or 3 hours a month to update it. It's not a huge investment to honestly have somebody. A lot of times they'll bring in a bookkeeper or an accountant. It's nice to just have someone that can kind of manage them. Sometimes they don't know how good they are. They don't know if they're doing things right. Just have an experienced person to come in and just look over their shoulder, say, yeah, this looks good. Everything's okay. To me, it's just the peace of mind that it brings to a founder to just be like, okay, I'm not just guessing, I'm not just assuming. I actually have someone in there that understands this, that can tell me, I can have confidence that this is my results, this is how I'm doing, this is my runway based on how I'm currently doing. So just bringing in some discipline behind, I think without being able to do some kind of projection to your business, it's really hard to understand your runway.
Yeah.
And so I just think that anytime you feel like you're ready to really bring that kind of discipline, again, if you're just trying to get your business up and running, you're just trying to get some sales, some customers, you're just trying to figure things out, it's probably too early. You don't need anything then.
Yeah,
Once you've
I'm
actually,
with you.
yeah. So
I have to tell you this beautiful story. I've never had this. It was such an emotional moment, believe it or not. You're fighting. And I was CEO of a VC-backed company. We finally got a first, a real CFO, one who had done it before. And he spent not even 2 months just uh, getting the data clean, one source of truth, all of those things. And then all
yep.
of a sudden he said, come on in. And after I saw it, I said, gotta get the rest of the executives to look at this. What he had done was he had taken the business and created uh, a financial model that actually communicated what the business was all about in a wonderful spreadsheet put up on a big screen. And I looked at it and went, oh my goodness, I now understand our business. If we tweak this variable, it does that. If we tweak that variable in sales, it does that. If we do that with engineering, it does this. If we have this training for in HR, it does that. It was the most beautiful, emotional, because you're stressed out. And I said, wow, I am so grateful. It was the
Yeah,
most
and
beautiful thing in the world.
that's awesome. And I think, the thing to understand is like, we're not talking about like accounting statements, GAAP, any of that kind of stuff. Like you said, it's building management financials that show how the business actually works. Because a lot of times a bookkeeper's throwing something in QuickBooks it's got a million lines in it. It's so hard to read. They look at it like, what is, how do I make any sense of this? So it's, and imagine the challenge at Overstock. We had a completely internal financial report we built that explained exactly how our business ran. And then we had GAAP financials, and they didn't even look like each other. And I had to somehow translate that. I had to be able to take our internals and turn them into GAAP. And we always had this constant trend because, again, the business did not care about the GAAP financials. They were meaningless, right? We ran on management, operating. So that's what they can do for you, is build out what's really happening here. What are the key metrics we need to look at? What do we need to think about? Again, we do things under accounting rules, and we try to make things consistent and the same so that we can look at past periods and current periods, and they actually mean the same thing. But that's what I'm not talking about. These aren't accounting statements.
No, no.
These are management financials that help you understand your business.
In a nutshell, I've often told my legal counsel as well as my CFO, I'm here to build a business. Help me get there. I don't care about the rest of the stuff. You
Right.
take care of that. Please help me grow the business. right? Ike's
Yeah.
looking at
Yeah.
this, right?
Yes. Yeah.
In the dialogue of growing the business, I don't want to know about GAAP. I don't want to know about all of these other things. Just protect us and grow it. In fact, you haven't even finished your story. You then went on to Mediconnect Global, helped grow that from X size to what size? You sold it,
So
right?
it was, yeah, when I got there, we were in the mid 20s, fast growing company. Same thing. I was the first CFO. They'd ever really had a real CFO. They were in a really good position. They were growing really fast. They had very profitable business. I went from Overstock, which was a retailer that, if you could grind out 5% at the bottom, you were lucky. To this business was a 40 to 50% EBITDA margin business, software. I was like, wow, I like this. I like this. I like B2B software. This is way better than grinding out a few pennies. I mean, at $1 billion, it was making about the same amount of money as MetaConnect was at 50 million dollars of revenue.
Uh-huh.
So it was that much more profitable. But yeah, by the time within 2 years, we had grown it. When we sold it, the year we sold it, it did 90 million in revenue and about 40 million of EBITDA. So it was an amazingly profitable business. Again, we had gone, our goal was we were looking at doing an industry roll up with a bunch of our competitors, and a strategic buyer came in, and luckily we were able to close that deal. And so they were a large public company that bought us for just under 400 million. So that was another great experience that I had with just, going through transactions. I'd done an IPO. We had bought and sold some businesses at Overstock, but this was the first really big private transaction, and just amazing experience.
This this background is great. Sorry, go ahead. You
No,
go.
it's okay. So um, I think we definitely created some credibility with our audience so far. So far, but I want to go back to basics a little bit.
Yeah.
I mean, in my history that I'm gonna draw it from there. I remember, in the previous business we were bootstrapped for 7 years, and then the VC came, said, Ike, you need a CFO, and we had no audit financials or nothing like that, right? So VCs need that
Yeah.
for sure. So I said, okay, I've been given my next task of finding a CFO, and I called Binoy. Binoy, what questions do I even ask to a candidate? Right? So, Binoy, do you remember that you sent me a Word file? So, that's one. Like, can you go into like what should a founder should look in a right CFO for her or him, and then I got to do it right after the Series A. Um, so there's that dynamic, like when to do it based on the investment, and final one. I'm just gonna pile up for you so that you can
Okay.
synthesize all of it. Um, you said you started at Overstock as a controller and then grew. So is that the part of the equation for a founder? To find somebody that they can get along and grew together.
Yeah. Well, let me just start with talking about hiring a CFO and just hiring, like, who you hire in a startup in general, because I think that's a really important thing for startups. Um, One of the things I've really learned, because again, I'm telling you about my past. I'm working with 4 startups right now, so I'm in the middle of startup world right now. This is not like something I did a long time ago. I'm in the middle of this. Some of them we've raised money, some we haven't yet. So
Mhm.
I'm dealing with this stuff right now. And one thing that I've really, come to reminded about is startups are not normal companies. And so when you go to hire people for startups, and this is the same with a CFO, they just have to have a different mindset. They can't worry about titles. They can't be worried about what they might be doing on a day-to-day basis. They can't be worried about their compensation. They have to be more concerned about the experience that I'm going to get. I know I'm going to wear a lot of hats. I know things are going to change all the time, which is probably the hardest thing for people to deal with. Is startups change. I learn a process and then we change it, and some people just don't deal well with that. And
Yeah.
so, and then ultimately, my goal is the reward can be much bigger if we pull it off and we execute, right? But I have to understand that the day-to-day grind is going to be hard. It's going to be lots of change. It's going to be unpredictable. And so a lot of people just don't function well in that environment. And so you have to be careful when you hire. And it doesn't matter what position in a startup, whether you're an SDR or you're the CTO, which is usually a co-founder, but somebody in maybe a software engineer, they've got to have that mindset. They got to be curious, like learning, like change. You got to figure that stuff out up front, or there's no point in hiring them, because they will go away. So what's unique about me, I think, is I'm at a stage in my life where I should be at a big company managing lots of people with a big salary, and what am I doing doing startups still? like why? So I feel like I have a lot of value because I'm willing to do that at this, and I do have some experience now of having done this a few times. Just so you know, I mean, just to give a little more background, between Mediconnect Global and what I'm doing now, we had a little family office called Reese Capital, and I literally sat through hundreds of pitches and talked to. So I learned a lot about investing in startups just from talking to so many founders, and in so many industries. So I lived a few companies, but I've also just given advice, followed, invested in, and all the startups I'm working with now I've invested in. So I've seen it time and time again. If you don't, so I'm a CFO that's willing to do that. I'm willing to work for equity. I'm willing to not get paid a big salary, which I could be out doing right now somewhere, because to me that just sounds so boring. Like I can't, like I just couldn't do it, right? Like I have to be in the middle of building stuff, helping, where I feel like I'm really adding value. I'm spending my time actually building, not in meetings and managing people. And so I do some things. I do some very basic things for some of these companies that most CFOs at my group, like, I'm not doing that. Like, I'm above that. To me, I'm not above. I'll do whatever. I mean, I'm here to help take all that finance and administrative stuff off the founder. So I think that you have to look for somebody who's willing to do that. Now, often they're a little younger, and that's okay. If you have someone who's been a controller, like I was I started as a controller at Overstock. My first CFO job was in a public company. That was a little crazy. I don't recommend that. but you could, promoting a controller that's proven themselves to your CFO, that's fine. And I've done one of the things I do now is mentor those first time CFOs, where I have clients that just call me and ask questions as a first time CFO. And I think that's another great use of like an Amplio or fractional CFO group, is you can just use them as a mentor. They call a couple hours a month. Just call it. If I would have had somebody to call back in those days, I was like on my own. Like I was just figuring it out. I was like, wow, if I knew anyone I could call to ask some questions about this, that would have been really nice. So I think that's the mentality that you want, is someone who's just there's no ego, right? You just have to let ego go when you're in a startup, and you have to love building, and you have to be curious, and that has to be the driver. And so you got to find a CFO that's like that. You don't want an accountant. You don't want someone who just does books. Like that's like, you're just trying to manage cash flow. That's what all you're doing at this point. Like we don't need really good accountants. You need somebody who understands business models and managing cash flow.
That's
right?
beautiful. Yeah, that was a beautiful, tight summary. The personality type, and important, you've said it multiple times, and someone who knows how to manage cash flow, which has nothing to do with debits, credits, and all of that reporting, just knowing how the business works. With that said, you also said you mentored and continue to mentor a lot of founders. Just maybe with some illustrations and stories, one or two things max you would advise first-time founders, because like you said, it's an unpredictable world. They're getting into it. They've already started. Our audience has already started on their way.
Yeah.
What's two things you would say, and give us an illustration that would make their lives so much more improved with your CFO specific background, having been an operator, an investor, a mentor? You're uniquely gifted to give that advice.
Yeah, I think the one thing I've really learned is most of the time when founders goes to start a business, they've found a problem that exists in the world, right? And they're out to solve it. And a lot of them have um, personal reasons why it matters to them, right? That they fix this problem. So number one is hopefully that's the kind of founder that you are, because that is what drives you to find the solution, right? So there has to be so much like resiliency, right? But the thing that I've realized is it's very infrequent that the customer that you think is going to buy that is going to pay for that solution you've developed. It's very rarely the one you thought it was. And but by building that, and that's why it's so key to last as long as you can, right? Because sometimes it takes a little while to find the true customer for your business. I'm dealing with multiple businesses. Here's one example. A business we invested in a few years ago. It's a business called Honk, and they came up with an app for managing tow trucks. And if you're a consumer, a lot of times if you're out in the middle of nowhere and you go get a tow truck, they just completely gouge you. So it basically created a marketplace where you could go, multiple tow trucks would be bidding, it would bring the price down. And so they kind of created this whole network for managing tow trucks. Well, on a consumer level, that thing was just kind of floundering, right? And at some point along the way, they realized that all the big insurance companies, car insurance companies, that all manage tow trucks for their customers, because usually you get one or two tows free as part of your car insurance. And it turns out that their infrastructure was so outdated. I mean, decades old. And so they've slowly been replacing large insurance companies back end. They've gone completely away from consumer. It's a complete B2B product now. And these customers, they're doing over $100 million of revenue now. And again, that's not what they built it for.
Yeah.
But the key is don't go in with this idea that you're just sure this is my customer and I'm going to force this to happen. Build something that's a great solution, and then let the market pull you to who wants it, and let yourself go there, right? And that's the key. And I made that mistake as a investor looking at companies early, as I focused too much on their original idea and not enough on the founder being able to find the right idea. And so I turned companies down because they had a terrible idea. But if I would have really thought about the founder, I would have realized they're going to figure out a market for their product. They're going to change. They're going to pivot. They're going to find a way.
That's
and so
huge.
I'm going to back that founder. And the founders that I'm working with now are like that. They are resilient. And again, same story, exact same story, where they built it. One of the companies for sure, they had their target customers built very specific for their industry, but I've had other ones, same thing, built it, a consumer app, and all of a sudden they get calls from businesses saying, oh, actually, we want that. And now they've completely pivoted to B2B, which is what you want anyway, right? You'd rather be in B2B all day, every day. Automatic distribution channel. Literally, we're raising money just to onboard customers. I mean, that's what you want, right?
Yeah.
To build a team for onboarding and sales. And so again, though, they were passionate. They built it. They were very frugal with their capital. They lasted for a couple of years, figuring things out without raising any real significant capital. Now we can go out of VC with a real business, real customers, real model. So my point is, don't give up when the original thesis that you have, it doesn't seem to be working. If you have a true solution to a problem, there is someone that most likely will want to buy it. You just got to find them. And so yeah, that's my advice is, again, as a first-time founder, the founder, if they're resilient enough, will usually find the customer at some point. If the solution really is a solution to a problem, a real problem. So anyway, that's one of the things I would say. The other thing I would just say is you really do have to have a fail fast mentality, right? You
Mm.
have to keep trying things. You have to keep changing things. If just don't keep butting your head against the wall if it's not working. Um,
Yeah.
Again, there is probably someone out there. You just have to keep figuring it out and trying it. And sometimes it takes years. It's frustrating, but and another reason why it's so important that you're so smart with your money until you find that product market fit. Don't get excited about being a founder and try to get a nice office or try to get like the stuff that doesn't matter. Don't do any of it. Raising money is not a badge of honor. It means you have to start giving away your company, right? You don't, that's not a badge of honor. Why would you give away ownership so you can have a nice office? Like the dumbest thing ever in my mind to do, right? So last as long as you can so that you can find that market. So that's the other thing I would say. Don't get hung up on an idea. Sometimes your timing's just wrong, right? Like it's a great idea, but it's going to hit that customer 5 years from now. Who's the customer today that will buy it? And eventually we'll get back to that customer who's, it just doesn't know yet that they need your solution.
Mhm.
Yeah. I've had, so not only did I hear you got to be resilient and passionate enough that you'll last long enough cash flow wise and be conservative, but number two, you'll get there eventually, and it takes a lot longer than you think. Both of those are such good advice. I saw Ike smiling at the same time and laughing. Uh, you're watching at the same time in a unique way. You're watching the CEO. You're watching that CEO struggle. You're watching that person have the highs and lows, and it can happen within hours of the same day.
Oh yeah.
And it is a tumultuous. Um, and looking back, you'll say that was the most fun ever, but it has a lot of downs, a
Yeah.
lot of downs, right? Hair on fire.
Hey,
What if
don't make fun of these founders. These are real struggles.
these are real? It's a real thing.
It
Hey,
is. It's real.
it's a real thing.
Only laugh or you'll cry. So
Yeah, you have to, and we're chuckling because we understand exactly how
We've
that
been
feels.
there. Yeah.
Yeah, and so and it's such a crazy ride. Nothing else compares to it. You don't want to do something boring, just like you said, David. Everything else is boring. Now, with that up and down, tell me, because I've seen it happen to me, and I've seen it happen when I was a VP, a CMO, to the CEO. What have you noticed? One thing that they do, or any uh, number of things, when they're stressed out, when people are stressed out, because this is very stressful.
yeah.
You may have rules for yourself, but I think it's a practical skill because this is an intense 100-mile triathlon type, and you've got to be able to last. And never mind money, never mind having a CFO. Can you go somewhere else and to say the good ones you've seen, they seem to come up with a way to manage that stress?
Well, I think part of it is having good advisors that they can call and talk to and ask questions that have been there, that have been through it, and can say, like, this is part of the process. I do also think that it's just the nature of, like, if you're a true entrepreneur and founder, you have some kind of innate ability to, I'd almost say it's delusional. It's almost delusional overconfidence, right? You have to
Yeah.
have that.
Yeah.
You have to literally believe, I don't care about all this outside noise. I know I'm going to succeed. Not everybody has that. Not everybody is born with that. So I think there's some inherent like ability to like see the world different than everyone else and actually just like blow it off where like those of us that aren't entrepreneurs are be more like, yeah, I'm out. This is too hard. I'm not doing
It's awesome, by the way, for you to celebrate founders being more delusional than confident. Like it's
that.
great to hear that from a CFO to celebrate that, and you call that a feature, not a bug.
It is because it's not, there are times when it's just makes no sense that you will be able to continue. Like it just doesn't make any sense. Yet
Yeah.
I'll come the next day and they'll have 3 more ideas about how they're going to make it work. Right. And they're like, which one do we start on? And it's, okay, you're crazy. We'll do it. Like, let's do it. So, yeah, I think some of it is just how they're wired. Every CEO I've worked with is just wired differently. I mean, the fact that they even tried to do this shows that they're crazy. I mean, most of them have left. The one guy, his parents are still mad at me because he quit med school to start a company. And so they're still like, what did you do? Why did you? And I'm like, look, that he's an entrepreneur. He's never going to be happy in a hospital. He just isn't. He's always going to start companies. I'm sorry. It's just who he is. Like, and so yeah, I think that's part of it. But then I think sometimes you just have to go, like, just go, get out of the office, take the team and go play laser tag, go, like, just do something, just get out, like, stop thinking about it. You can't fix it in the next 2 hours. So just go and just go have fun. Right. And I think you have to just do that. You just have to sometimes just say, you know what, enough's enough. And one of the startups, we actually rented an office where there's a basketball court inside the building, and half of it is that, like, it's so we have somewhere to go. Let's just go shoot. Let's go play lightning. Let's go shoot hoops. Let's get out of here. Let's take a break every day for a few minutes and just, like, be normal people. Stop thinking about all this. So I think you do have to have an outlet. Most entrepreneurs never stop thinking about it. Doesn't matter all weekend, but hopefully they have some family distraction that happens, and then they just have some. You just got to force them out of the office to do some other things occasionally.
Motorcycle.
Motorcycle. I was going to say, or a one wheel. We have all the learn how to snowboard.
There you go.
We've gone
There you
through
go.
all of these, right? You got to track.
One other thing I would say real quick is, I do think that we're doing entrepreneurs a little bit of a disservice in Utah, where I am, where we celebrate entrepreneurship long before they've actually done anything. And maybe it's a little bit of a mental health thing, or but I think it actually puts more pressure on them when we, like, focus on, oh, he's a founder of this company. Well, and they haven't, even been successful yet. They haven't really even done anything yet. They're still trying to build. And I see him at these events, and I see him and I think, why are you at an event? You should be at your business. Like, you should be building it every second. Why do you have time to go network? Like, you're in a startup.
That's the CFO in you instead of the salesman. Dude. That's the CFO.
Like, if we can get more sales by you going to that networking event, then you should go. But if not, why are you there? And so, again, being an entrepreneur is not something to celebrate on and of itself. Let's actually build a great company, and then let's celebrate that, right? And I think if it doesn't go well, then all of a sudden you've had this spotlight on you, and it fails. It's almost worse, almost more pressure. So I just, I think I love that we do a lot of events and we do a lot of things to celebrate entrepreneurs, but let's stay head down until we build a real company first before we celebrate.
Nice.
But I think a lot of it is just kind of to boo each other up, because it's so hard and it's such a grind. But there's just almost too many of those in my
Yeah. That's because we're old, dude. We're old school. And like you said just a moment ago, there's an element of raising around does not mean success. Does not mean success.
Yeah.
Can we drill down on that one? I was gonna go back. You said raising money is not the badge of honor.
Well, I mean, of course, raising money shows that somebody's interested in your business, and that's a great thing, right? It shows that you have runway and that you have a future. That's great. But then we don't celebrate the companies that don't actually ever have to go out and raise venture capital. Like, they get highlighted. The VCs love them because they make money off them. Nobody talks a lot about Overstock in our community because we never raised venture capital. We literally went from funding ourselves to an IPO, and then raising money from private money, hundreds of millions from Fidelities and the big mutual funds. And we skipped venture capital because at the time, venture capital wanted 2 times participating preferred returns, just like crazy things. Like, our money twice, and then we participate in our ownership. Like, it's like, who's going to do that? Like, it's horrible. So we never did. And yet, like, the community doesn't talk about it because none of the VCs invested in it and none of the VCs made money off it. And then there's a whole bunch of companies out there that never raise capital and are very, very successful. And we just never talk about them, right? And so the reason I said that is because when you raise money, you dilute your ownership, right? And you own less of the company as a founder. And so you only raise capital if you have to raise capital to grow your business. And if you do the math, if I dilute 20%, I can add 50% to my value. There has to be an accretive, right? It has to make sense to your benefit. I'll be a bigger company. I'll own less, but I'll be more valuable than if I went on my own. The only reason you should do it, not as a badge of honor to say I did it. And this is the other thing I would say is we made the mistake at Overstock where early we were raising $1 million at a time. And we were so frugal and we were so tight. And we used to joke that we sat on box crates were our chairs. And we kind of were proud of how cheap we were. And then we got into a market where it was really easy to raise money for a while. And so we raised a $200 million convertible debt note. And all of a sudden we had all this money. This was after we were public. And we went out and bought a company for way too much. We were buying our stock back. We tried this, we tried that. We did all these things that distracted us from our core. None of them really worked. We never would have done those, but we just had too much money sitting in the bank. And so you're just always, that's when people go build buildings. Whenever I see that, I'm just like, I know in 3 years, 2 years, it's going to be empty. There's going to be one floor filled and there's 3 floors are going to be empty. Like, it's just, and you only do that when you just have money laying around. So I don't raise more than you need it's my story. Raise what you need, give yourself a runway, but don't raise just because the VCs will give you the money. Don't raise a whole bunch of money because you'll probably do something stupid with it.
Yeah, that's great. Bino and I always talk about, like, if you can recognize something as a founder, you probably have it in you. So that's why I'm trying to bring some attention to these type of things. I think if you look at it, first time founder versus second time founder, like the things that they do differently.
That's
the raising one is probably one of those, right? And the second one I know of is like rather than revenue, it's revenue per employee is the count. Like, what are these type of things that you can tell us, like the difference between first time and second time founders, so that our audience can actually catch them, like themselves, what they're doing wrong, how their thought process is wrong.
Dilution is a big one, first of all. The not understanding that when they take money that they own less of the company, and not really doing the math on, okay, my seed round I diluted this much, now I have an A round, then if I have a B, like I just keep diluting. Where am I going to be when this is all done? And most good investors are careful at trying not to dilute the founder too far, so that they own enough of the company that they care when it all in the end, right? But still, I think there's a lack of understanding about that, to the point that they get taken advantage of when they're small. Some of these incubators or other things will come in and say, oh, just give us 20% or give us some number. And they don't understand what that means, that, oh, that's way too much. So I think just making sure they talk to somebody before they make decisions like that, like go get outside advice on, hey, somebody's offering me this money. Does that seem realistic? This much for this much ownership, get a second and third opinion before you agree to something like that. I've seen some really sad situations where people didn't realize what they'd done. Most of the VCs that I work with are really good and professional, but there are some that aren't and that will take advantage of founders. And so I think they just have to be careful. So that's a big one. I think, again, another one that's really, really important is co-founders. Make sure when you bring in co-founders that you understand your ownership, but that your ownership vests over time. Okay? Because you realize when you give somebody 30% of the company and there's no vesting, they could walk out after 2 days and they have 30% of the company. So make sure your founder shares vest over 4 years, always. So the ones that are really dedicated will be there. They don't care about vesting. They know they're going to be there till the end. The fake founders will fall out, and that's fine. They'll get the piece that they earned, and then they'll be out. Because when you have dead ownership on your cap table, it creates all kinds of problems when you go to raise money. So it's just a dumb little detail, but it makes such a difference. So in other words, even though you own all the shares of the company as co-founders, you have to earn that over time, just like anyone else would have to earn it. And again, it's to protect you. And usually who it protects most is the founder, right? From co-founders that don't have the same. And again, I don't think they ever intentionally do this, but they just don't have the same stamina, don't have the same passion.
Life happens.
Things are going hard. Yeah, they have personal situations where they need to make money. Like things just happen where they need to leave, and then you don't have this issue. So that's another common mistake I see founders make. And then again, just this. I think we're back to normalcy, where it is really hard to raise money again. So bootstrapping as long as you can, being conservative with cash, is back in fashion. And it's necessary. Honestly, I went to a meeting recently with a bunch of early stage VCs, and like the power is all completely back on them now. Like they are being so picky, and things that so you can't assume that, it used to be that like if you have a little bit of traction of some revenue, oh yeah, you'll get funded. Like it is not like that anymore. They're investing in the best of the best. So don't just assume you can raise money.
Mm-hmm.
You're gonna have to have traction of some kind before anyone's going to give you money. So just know that you've got to figure out a way to make revenue. You've got to find customers. You're going to have to do all that work with friends and family money, angel investing money. No VC's it's very rare that a VC is going to fund an idea anymore. It's going to have to be, you're going to have to show traction. So I think that's a really key thing.
Thank you. 3 great ideas. Can I ask, because it's along the lines that I know only a CFO-minded startup guy would have insight. Managing the investors, the board, managing advisory or a full board that has investment in it. Having done this now multiple times, give us some war stories of poorly done relationships, and that in itself will share to our listeners what's happening. They'll understand. I'll give you one right now. One of my CEOs, when I wasn't the CEO, completely cooked the books for multiple years. And so a new CFO came in under the board's advisement, and they noticed something was off. And there was one day, the chair of the board came in, and as quietly as he could, but it was hard not to notice that some people came with the board member and physically escorted that CEO out of the door. And then there was a meeting with all of the C-level suite. So what happened, what's going on, whatever. I mean, clearly that's a drastic no-no and an opposite, but my goodness, that leaves an indelible impression on what not to do with anybody, regardless of board or not. That's not just good business. That's not good human sense, right? So I've gone through a lot of examples, good and bad. Any insights of what not to do or what to do that these CEOs? Yeah.
I think again, when you're starting out, as tempting as it is to take money, if you should talk to other people that they've invested in. And if they're not willing to let you talk to other founders, that's a really big red flag, right? So I want to talk
Why?
to,
Why is that?
well, why wouldn't they want you to talk to their founders, right? Most likely that means they've probably had a bad experience, because most board members when you're early are VCs, right? They're the people who've put the money in, then they get a board seat. And I recommend you keep boards small. Like, you don't need a large board as a small company. You don't need a whole bunch of, talking heads. You need founder really is the one that knows what's going on. They're the ones in there day in, day out. What you're really looking for in investors are people who can help you get customers, help make introductions for people that work there, helping to introduce you to other investors. That's been invaluable. Who's the next round of investors? If I've raised a seed round, who are the A round people? That's what your board should be doing. And then they're there when you have questions and want to talk to them. But they should be you want to find people that are very, very founder friendly. Like, I'm on a board right now. The board, there's two VCs and the founder, and I'm an observer. Founder has 3 votes. The VCs have 1 each. Founder can outvote them on everything.
Yeah.
Right? Of course, he's never going to do things where he doesn't have the support of his board, but he knows that the board can never come in and just run him out, right? Because they don't know. They're not there day to day. Now, when you have fraud and you have these kind of things, it's a little different. But again, you don't know that CEO had any knowledge of that. So anyway, my point is, really early stage, you don't want investors that want to get involved. They don't know. They're there for money, support, helping you bring in relationships, helping you bring in customers. They're not trying to tell you how to run your business. Most of them never run a business themselves, right?
Yeah.
So
That's a scary truth.
yeah. So again, very much there to support, make introductions. If you have questions, God, I'm struggling with marketing. Oh, we got a portfolio company, amazing head of marketing. Let's have you make a call, talk to him. He'd be glad to, have a conversation. That's the kind of VC that you want. They're partners. They invest. You want investors who invest in the founders.
Yeah.
That's the number one reason they're investing in you, is they believe in you and that you're going to figure it out. Not that they're going to tell you how to do it, that they're going to get in the middle, or that they're really greedy about trying to take as much ownership as they can. Run from those investors. I've heard of, people retrading at the last minute. Here's our deal. Last minute, they changed. Like, just run from all that. Never work with anyone who's like that. So yeah, I think to me, a board should be, there's a support. It should be small. It should be only the people that have skin in the game and who can actually, like, they really do care on the outcome, because they've either put enough money in that it matters to them, but that they trust the founder, and that's why they invested. That's the kind of partners, investors that you want.
I have to concur.
There's not a ton. There shouldn't be a ton of board interaction, honestly, when you're early. I mean, that it just shouldn't be a big part of your business. Now, as you get bigger, as you grow, and the board gets more involved, that's great. Make sure you have, just make sure you also have good attorneys that can help. We use a group called Savvy Legal a lot. They're very inexpensive for startups. Find someone who's inexpensive, who focuses on startups, that can make sure you got all your legal documents in place. Then have a finance person that can review everything. And again, make sure you have boards that are very founder friendly, and talk to some of their founders before you take their money.
Yeah, I think that's sage advice. I was going to jump in and just say, I have found myself in it as well, but I've seen it in others. Too many people so desperate because of lack of cash, where the oxygen starvation actually makes you make poor decisions and just take any cash from anybody, because at least you're buying a little bit more time versus
I understand.
being, you understand that. And it's a normal cycle. I almost said desperate, but it is desperate, and it can go up and down. And I've relearned a lot including if you definitely know that your business is going to require investments and investors, to start the process really early in a deliberate manner that is calculated, is part of the growth of the business, and you allocate time there proportionately from day one. So it's not a ad hoc, okay, gotta go now, we need the cash, and then it's too late. And to including making sure you vet the investors as much as you would any member who joins your company, for they completely can impact positively or negative, like you said, based on the caliber of people they are. So, oh,
Yeah,
uh,
fundraising is a long process. You just have to plan on that. I've seen, seed rounds go over a year, 18 months, where you're bringing in a little bit at a time. So yeah, it's not something that you can just do. The last thing you want to do is go in out of money, because that's where you'll get taken advantage of. You got to ask when you don't need it yet, right? That's like everything, like every bank in the world, right? They'll give you money as long as you don't need it. Uh, so yeah, you at some point it becomes all in their favor, and they have all the leverage, and then you get desperate and make a bad choice. You're almost better at some point to literally start over, to not
well
take
done.
that money
Yeah.
and just
Right.
start over.
Well
Now
done.
that you're at this point, go to somebody, go to a good investor, say, I've got it to this point. I'm starting over. I need new, I don't know. You just figure out a way. You're you always think the road is over, but if you really do have something legitimate, you can find somebody that will help you. And you might need to go to your personal network. You might need to go to friends and family, but it's better than taking toxic money, because that will kill your business anyway.
Yeah.
Most,
Yeah, I don't think our audience realizes that's an option,
That's right.
right?
I,
yeah,
yeah.
yeah. It's a drastic option. I get it's not like, the one you want to do, but
It is,
on
but
the company still when you start.
but if the money, let's say, like you said earlier, comes with 2x 3x preferred,
Yeah.
you know, um, the
Yeah, the chance of you ever getting any.
yeah, so even if you have, say, 40% of the company, but you sell the company for, say, $10 million, but you have to pay the investors $9 million, or 15 by default, you have nothing left. So at that point, you have to make your calculation so that it's easier to do. Then, and on paper, like we also said, on paper, VCs will make sure they are, like, from common stock perspective, they're never 20%, because they don't want to manage the company.
Mm-mm.
There's already probably they're like probably four people with 30 investments, so they're never gonna have enough time to manage it. They barely have enough time to go from board meeting to board meeting,
That's right.
right? So, uh, if you're that desperate, you're gonna take that money, and after you take that money, even if you work your
Yeah,
everything
it's
off,
working for them
and
now.
then 10 years later, you're going to end up with $200,000. Go work somewhere else for $200,000 salary
Right.
for 10 years.
Right.
Oh, beautiful. Hey, we've run out of time, Dave. I just realized we could have you on a whole different thread. And if you're open, we'll invite you back. Hey, a question. It's
Yeah.
a loaded, fun question.
Okay.
Uh, is it easier? Is it more fun to start something from scratch, or to go with a going concern that's small enough that you can jump on and become one of the originals? Right? That already has momentum. There's a difference between 2 million and 10 million versus 0 million.
Yeah. Yeah.
What, what, what are your thoughts on that?
Well, I don't think it's a bad idea if you want to be a founder, to first join a startup and kind of learn how a startup works, not being the founder, and actually, spend some time working in a startup. I mean, when I'm in startups, our whole goal is that people that we bring in, leave the startup and start their own companies. You're going to start a company much better if you've already been in and learned some of those lessons, like in a startup. It's hard to tell somebody that if you haven't experienced it. When you've experienced it, like, I don't know, we just don't learn lessons very well unless we learn them ourselves. Kind of like our kids, right? We can tell them and tell them and tell them until they actually go through it themselves. They just don't listen. So I do think there's some benefit to that. Getting into something that's not brand new, but fairly new and has revenue, but maybe it's still trying to find true product market fit and jump in and kind of get part of a team and kind of learn the ropes a little bit before you go in and just do it yourself. It is hard, and I would say there's also a difference between starting a company that is is a competitor to something that already exists versus starting a brand new idea, right? That's very disruptive. Overstock was not a novel idea. It wasn't the first to do it, but by coming in as third, we could kind of learn from the other two, and we didn't have to figure everything out ourselves. And then you just have to differentiate, right? That your whole goal is, how are we different? The market's massive, 3 players. We can get a piece of that and still be really big. Versus when you start a brand new thing, there's often a lot of times of educating the customer, convincing them that it's okay, getting them to trust before they'll buy and use it. And it's usually a longer process to getting product market fit when you're really disrupting or coming up with something new. So you just have to know that, but the opportunity is much bigger in those situations where if it really works, you could potentially own the market or be a big piece of the market. But the education process is long and painful usually.
Yes.
By nature, we don't like to change. People don't, companies don't, especially when you get into enterprise, right? The sales cycles are longer. And so anyway, I don't think it's a bad idea if you want to start a company to first jump in and work at an early stage company and learn a few of those things first. Because again, they'll have a much bigger impression on you than if you just listen to this podcast and I tell you these things.
Yeah.
You jump in and do it, then you'd be like, oh yeah, he was right. This is hard. This is really painful. Do I really want to do this? And either I'm going to be like, I love this. I love this feeling. This is amazing. It's crazy up and down, but this is exciting. Or you might be like, yeah, I don't want to do this. I'm just going to work for someone else. I'm not going to waste 3 years of my life finding that out. I just found it out. So anyway.
Thank you. You are a star. We have not had someone with that great background and a perspective. It's very unique, Dave, and we are very grateful that you came. We're going to close up. Any comments for Dave?
No, Dave, you've been awesome. Thank you. I hope you come back soon again.
All right. Thanks, guys. It's great to talk.
Thanks so much. And thank you. And all the listeners, I hope you guys enjoyed Dave's very unique perspective. That was so real, including the comment, you can always trash it and start all over again. And that's a real thing. So with that said, tune in next time. Thanks again. Thanks, Dave. Appreciate it. Bye-bye.